Hi, my name is Mary Pearl Payadu, tutor for corporate financial analysis. In this session, we'll be dealing with relative valuation, economic value added, and market value added. So, by the end of this session, you should be able to explain relative valuation, discuss IVA or EVA, that's economic value added and net significance, and also evaluate the market value added of a business. So, we'll discuss the following as listed earlier through the value creation process of companies. And when it comes to market valuation, we made mention that there are three approaches to valuation when it comes to business valuation. We have the discounted cash flow, the asset-based valuation, and the relative valuation. So when it comes to relative valuation, here you want to know the value of an asset based on how similar assets are priced in the market. So when there are three essential steps in relative valuation. First is to find a comparable asset that is being priced in the market. Secondly, you scale the market prices to a common variable to generate a standardized price that can be comparable. And third, you adjust for differences across assets. Based on our previous discussions on the various approaches to valuation, when it when it came to the absolute valuation or the discounted cash flow approach, we made mention that it has to do with finding the value of an asset based on its cash flow, the risk, and also the growth potential. And when it came to the asset based valuation, you are trying to find the value of a business or based of a business based on the assets, the value of assets and liabilities. And that is where you have to revalue the assets and liabilities of the business. Now, when it comes to relative valuation, here you are trying to find the value of an asset or a business based on similar items or the price of similar items on the market. Now, the objective and components of relative valuation are in two folds. The first one is to value assets based on relative basis. In other words, the prices have to be standardized, and you do that by converting the prices to multiples of earnings, book values, or sales. And secondly, you have to identify similar firms in order to compare the standard multiples and determine their relative adequacy. Now, there are several methods that can be used under the relative valuation. The first one is the relative earnings valuation method, where you can use the PE ratio or earnings multiple or the PEG ratio. So the PE ratio is simply the price earnings ratio. That's the price of the stock divided by the earnings per share. And we have the PEG, where the G represents the expected growth rate of earnings. We also have the relative revenue valuation method, that is the PS ratio or the price per sales per share ratio. So price divided by sales per share. We also have the relative cash flow valuation method, where you have the price per earnings before interest and taxes, or price over EBIT, or price over EBITDA, or price over CFO ratio, where the CFO represents the cash flow from operating or operations, and the EBITDA is the earnings before interest and taxes, depreciation, and also amortization. Now, there are various reasons why the relative valuation approach or method has become popular. First is because it is less time and resource intensive than the discounted cash flow valuation method, where you have to estimate your cash flow, you have to calculate your weighted average cost of capital and all that, find your relative risk, calculate the CAPM and all that. This particular method is very less time use. This particular method uses very less time and also less resources, and also it is more likely to reflect the current mood of the markets than all the other approaches, since it attempts to measure relative and not intrinsic value. Although it is popular and has a lot of advantages or merits, there are other potential pitfalls when it comes to using the relative valuation method or approach. The very first one is that it lacks transparency of its assumptions and it makes it vulnerable to manipulation. Also, it can result in values that are too high or too low because the multiples reflect market situations, which may be undervalued or overvalued when doing comparison. So in situations where you have a market or a period where businesses are being overvalued in the market, when you use the relative valuation in such a situation, you can have overvaluation of an asset or of a business. And similarly, when the market is undervaluing a particular company or assets, you may have that kind of situation when you use this method. So, in relation to the concept of economic value added and market value added, according to FAR 1995 and Riley and Brown 2003, market value added is the difference between the total market value of a company and the economic capital. So we have a company's market value being equal to the sum of the market value of its equity and the market value of its debt. So market value added or the company's market value is simply the sum of the market value of equity and the market value of debt. We also have invested capital, which is the amount that is actually introduced or put into the company, and it is basically the tangible non-current assets plus the net working capital. So the market value added is simply the difference between the market value of a company and the invested capital. In other words, when you take the value of or the market value of your equity and your debt, when you subtract the invested capital or the capital you put into the business at the beginning of the company, if you have any excess or surplus, that will be your market value added. So it's simply market value of a company minus invested capital. And you should note the market value of a company includes that of debt and equity. So the sum of your market value of debt and market value of equity will give you the market value of the company. When you less the invested capital or the money or the amount of funds that was put into the company at the beginning, then you have your market value added. So market value added or MVA is simply the surplus when you deduct your invested capital from the market value of the company. When it comes to economic value added, this is an internal measure of performance that drives market value added, and it takes into account the full cost of capital, including the cost of equity. So it is an equation that includes the return on invested capital, the weighted average cost of capital, and the invested capital. So in other words, the economic value added is the difference between return on invested capital and the weighted average cost of capital, and that is multiplied by the invested capital to give the economic value added. Alternatively, you can calculate the EVA using the NOPAT, and that's the net operating profit after taxes, and it is equated as NOPAT minus a bracket open WACC times invested capital. So economic value added is the difference between the product of the WACC times invested capital subtracted from the net operating profit after taxes. In other words, the MVA or the market value added is simply the present value of all future economic value added. So there are reasons for adjusting the economic value added. The first one is to convert from accrual to cash accounting. So we know that there are two main bases of accounting. Either use the accrual method or the cash accounting method. The cash accounting method is most preferred by investors because it actually has to do with real cash. However, when you have to convert from accrual to accounting, or when you have to use the economic value added, there's the need for you to convert from accrual to cash accounting basis due to a number of reasons. First, because of investor preferences, and also because the cash accounting is more ideal, unlike the accrual that has to do with a lot of prepaid expenses and accrued expenses as well as income. Now, another reason for the adjustment of economic value added is because spending on market building items such as research or R&D, staff training, and advertisement costs are to be capitalized to the extent that they have not been in the financial statements. And also, unusual items of profit or expenditure should also be ignored. Adjustments being made to the accounting profit in order to arrive at the NOPAT, since the NOPAT can also be used to calculate the economic value added. The first one is that expenditure on promotional activities, research and development, and employee training should be capitalized. By capitalizing, they should be reported in the statement of financial position, and as and when they are being exhausted in a particular accounting year, they can be reflected in the statement or the income statement or statement of comprehensive income. And also, depreciation charge is added back to profits instead of instead of depreciation, a charge for economic depreciation is made. So we know that depreciation is a non-cash items, and like we made mention, in calculating the economic value added, you have to make several adjustments that includes converting from accrual basis of accounting to cash accounting. And now, since depreciation is a non-cash item, you add it back to profit, and instead you charge an economic depreciation. However, in cases where you cannot or you do not have an economic depreciation, you should make sure that the depreciation charge you are using is a reflection of the economic depreciation, and that is based on very reliable information. Also, non-cash expenses should be treated with suspicion, as they are likely to reflect the finance director manipulating profits rather than any real cost. So we know there are other non-cash expenses such as provisions and allowances for doubtful debts and all other similar expenditure. You would want to treat all these ones with suspicion and critically scrutinize them in order to make sure that they are not items that are used to manipulate profit. Also, the tax charges should also be based on cash and not accruals. There are several purposes for using the economic value added, and the first one is to use them to determine management bonuses. Also, you can use them to motivate management to achieve sales objectives and goals. They can be also used to measure performance, okay, so or set organizational goals and objectives. Also, corporate valuation for shareholders and bankers can be used using the economic value added. Similarly, capital budgeting and investment decisions can also be used using the economic value added. Like we made mention, it has to do with the invested capital and also the weighted average cost of capital. Simply, the market value of equity and debt are all incorporated in that. So in this session, we discussed relative valuation, and that is valuing an asset or a business based on how similar items or similar assets are priced in the market. We also discussed economic value added and market value added, and we made mention that market value added is the future value of all economic value added. We also made mention or we listed several purposes of economic value added and how to do accounting adjustments before using it. Thank you.